Welcome to this lesson on futures contracts. Today, you'll learn about a powerful financial instrument that allows traders and businesses to agree on buying or selling assets later at a price set today. Futures contracts play a crucial role in modern financial markets, helping manage risk and provide opportunities for profit. A futures contract is a legally binding agreement between two parties to buy or sell a specific asset at a predetermined price on a specific future date. Think of it as making a promise today about a transaction that will happen in the future. Both the buyer and seller are obligated to fulfill this contract when the agreed-upon date arrives, regardless of what the market price is at that time. Let's look at a practical example to understand this better. Imagine a farmer who agrees in March to sell 1,000 bushels of wheat in September at $7 per bushel. Both the farmer and the buyer lock in this price today, in March. No matter what happens to wheat prices over the next 6 months, whether they rise to $10 or fall to $5, both parties are committed to the $7 price they agreed upon. Futures contracts have 4 key characteristics that distinguish them from other financial instruments. First, they are standardized, meaning they are traded on exchanges with fixed contract sizes and specific delivery dates. Second, they create an obligation for both parties to fulfill the contract terms. Third, they offer leverage, allowing traders to control large positions with smaller upfront margin payments. Fourth, they involve daily settlement, where profits and losses are calculated and settled at the end of each trading day. Futures contracts differ significantly from stocks in several ways. When you buy a stock, you're purchasing actual ownership in a company and paying the full price upfront. Stocks have no expiration date, and you settle only when you decide to sell. With futures, you're entering into a contract obligation without owning the underlying asset. You only pay a margin, which is a fraction of the contract value. Futures have fixed expiration dates and are settled daily, meaning gains and losses are calculated every trading day. Futures also differ from bonds in fundamental ways. When you buy a bond, you're essentially lending money to the issuer and receiving fixed interest payments over time. Your principal is returned when the bond matures, making it a relatively lower risk investment. Futures contracts, on the other hand, involve agreeing to trade an asset at a future date. Traders profit from price movements rather than interest payments. There's no principal investment that gets returned, and futures carry higher risk because they're primarily used for speculation or hedging. Futures contracts serve 4 main purposes in financial markets. First, they're used for hedging risk, allowing businesses to protect themselves against unfavorable price movements in assets they own or plan to purchase. Second, they facilitate price discovery, as futures markets reveal market expectations about future asset prices. Third, they enable speculation, where traders use leverage to profit from anticipated price movements. Fourth, they allow for arbitrage, where traders exploit price differences across related markets to earn risk-free profits. The key takeaway from this lesson is that futures contracts let traders and businesses lock in prices today for transactions that happen later. This makes them a powerful tool for both risk management and price speculation. Whether you're a farmer protecting against crop price fluctuations, a company hedging against currency movements, or a trader seeking profit opportunities, futures contracts offer unique advantages in the financial markets. Understanding how they work is essential for anyone looking to expand their knowledge of advanced financial instruments.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.